Should there be a defining phrase for the impact of globalization in recent decades, it unquestionably would be made in China. The tensions with the US, Hong Kong situation and the growing authoritarianism under Xi Jinping raises uncertainties about globalization's future. Even if China's role as the world's factory diminishes, other nations like Singapore, Japan, Malaysia, Indonesia, India or Mexico might step in, from advanced to basic industries. However, our focus today is on a potential major beneficiary, Vietnam. Amid the China-US trade conflict, Vietnam emerged as a top winner. This video delves into Vietnam's strategies for growth and its capacity to absorb redirected investments, and poses the pivotal question: can Vietnam evolve into a miniature version of the new China? Join us as we explore. To gauge Vietnam's ability to navigate the impending wave of globalization, we must grasp its origin and trajectory. Initially, Vietnam's recent history mirrors China's remarkably. Both nations were communist, closed to global trade, and deeply impoverished. A strange similarity emerges here. Both countries embarked on a similar route out of poverty following the demise of their communist leaders, Mao Zedong in China and Ly Duan in Vietnam. They initiated reforms to privatize parts of the economy and welcome foreign investments. In 1986, Vietnam began a transformative movement known as Doi Moi, aiming to shift from a centrally planned communist system to a socialist market economy. This initiative abolished collective farms, granting families individual plots of land for autonomous farming. Peasant families were permitted to sell their produce and price controls were lifted. Beyond that, Vietnam dismantled the licensing system that previously restricted entrepreneurship, granting greater freedom to start businesses. Moreover, significant sections of the state-controlled economy were opened up to private enterprise, expanding into previously prohibited sectors. The impact was immediate. Vietnam experienced over 360% growth since Doi Moi's inception, maintaining an annual growth rate of approximately 7%, surpassing neighboring countries. Industrial growth soared, transitioning away from an unproductive agricultural sector. Shifting people from rural areas to factories contributed significantly, accounting for 5 out of 7 points in annual growth. Crucially, Doi Moi not only spurned an industrial revolution, but also broadened trade agreements globally, boosting the economy through increased foreign trade and investment. In 1985, exports made up around 5% of Vietnam's GDP. By 2010, this surged to 90%. Foreign investment, surpassing even China's percentage relative to GDP, owed much to special economic zones, areas offering tax benefits and fewer regulations, enticing foreign capital and boosting domestic exports. However, concerns arise about the nature of investments, whether they predominantly involve sweatshops with child labor producing low-cost items like balls or t-shirts. Yet the textile sector represents less than 10% of Vietnam's foreign investment. Electronics and chemicals emerge as the primary exports, simplistic yet significant. Considering this data, Vietnam appears primed to attract substantial investment. Its diversified exports, focusing on electronics and chemicals, showcase a shift away from mere agricultural reliance toward a more varied economic landscape. Amidst all these statistics, an important aspect warrants consideration. Vietnam remains significantly impoverished, far below China's economic status. It maintains a standard of living akin to India or Mexico 5 decades ago. While Vietnam's recent growth has been impressive, its persistent poverty stems from 2 factors. Initially, Vietnam started at a low economic point, half as prosperous as China in 1986 and persistently lagging behind. Additionally, Vietnam initiated its reforms a decade later than its Asian counterpart, limiting the time for development. This brings us to the crucial question: can Vietnam become the new China? Indeed, it's pertinent. Investors seek not only low-cost environments, but also strong domestic markets for manufacturing and local sales. Given Vietnam's struggling economy, this poses challenges, unlike China where many companies remain despite recent issues. Moreover, Vietnam's growth by relocating workers from fields to factories faces limits. The pace of this transition has slowed by over 30% in the last decade compared to the previous one, indicating a diminished capacity for further movement. The key queries emerge here. What strategies can Vietnam employ to sustain growth, modernize, and attract increased investment? Is the apparent economic slowdown natural or indicative of underlying issues? Let's delve into the law of minimum effort. Undoubtedly, Vietnam's growth has been impressive, bordering on miraculous. Yet a significant academic consensus suggests that if not for substantial mistakes, Vietnam could have achieved much higher growth. Three prominent problems persist, hampering the country's future growth. While discussing China's advantages during its initial foreign investment attraction, factors like size, low wages, and taxes are often cited. However, a less discussed advantage was China's reasonably well-educated population. Without an ample number of skilled professionals, operating factories or driving innovation becomes difficult. How does Vietnam fare in this aspect? Initially promising, Vietnam boasts the region's highest human capital index, surpassing even China. Yet this success is primarily due to a youthful, healthy population with a decent secondary education. However, further advancements seem limited. Furthermore, considering the percentage of individuals with technical education, Vietnam ranks the lowest in the region. While educational reforms have shown success, advancing up the development ladder necessitates better training for workers crucial to an economy. Yet, compared to other issues, this appears relatively minor. Despite 98% of the population having access to electricity due to substantial government investment in infrastructure like transmission networks, frequent outages persist. The grid's capacity falls short, notably problematic as Vietnam seeks power-intensive industries. Compounding these challenges, Vietnam grapples with dilapidated roads, a lack of river navigation, and a railroad system to offset the poor state of national roads. Water quality also poses significant concerns, even in exclusive economic zones, an unsettling reality. Why do these infrastructure woes persist? Not due to insufficient investment, but neglecting maintenance. Over the past 2 decades, the government poured funds into construction without prioritizing maintenance. Merely constructing infrastructure isn't enough. Neglecting upkeep squanders investments. Alarmingly, a mere 10% of spending focuses on maintenance, contrasting sharply with the OECD's 30% average and neighboring countries like Indonesia reaching 40%. Adding to these challenges is pervasive corruption and extensive bureaucracy, exacerbating final outcomes. For instance, of every 100 Vietnamese dongs allocated by the government for irrigation maintenance, a staggering 70 are swallowed by administrative costs, often synonymous with officials' pockets. Government subsidies heavily promote infrastructure usage, resulting in accelerated wear and tear. However, the public sector's diminishing role in Vietnamese industry, plunging from 55% in earlier years to under 15% today, primarily owes to increased foreign investment and not robust local private sector growth. Remarkably, this trend is a deliberate choice by the government, avoiding the emergence of a competitive local business elite akin to China's Alibaba or Tencent. State-owned enterprises, SOEs, persist as a vital segment of Vietnam's economy, monopolizing crucial sectors like finance and infrastructure. Unlike other nations transitioning to a market economy, Vietnam opted against extensive privatization, instead granting greater autonomy to SOEs and merging struggling enterprises with healthier ones. Although the number of SOEs plummeted from 12,000 pre-Dewey to 3,000 today, their GDP influence barely decreased from 37% in 1990 to 36% in 2010. Regarding SOEs' performance, they fare abysmally. Studies reveal SOEs are 3 times less likely to close despite financial turmoil compared to private companies after Vietnam's entry into the World Trade Organization. While private firms significantly enhanced productivity, state-owned counterparts showed no improvement, yet continued enjoying steady income. Complaints from Vietnamese entrepreneurs underscore the unequal playing field. SOEs receive preferential treatment in loan acquisition, primarily from government-owned banks. Additionally, they benefit from free land grants and favored access to government contracts, disadvantaging private enterprises. Let's delve into specifics to highlight the vast productivity gap between private and state-owned enterprises. One metric to assess this gap is the capital efficiency ratio, revealing how much investment generates an additional dollar. Vietnamese private companies boast a ratio of 0.47, while state-owned counterparts sit at a staggering 1.62 within the same sector. This indicates that state-owned enterprises must invest over 3 times the amount to achieve equivalent results. Economists suggest that aligning Vietnam's public sector with neighboring countries could have bolstered growth by 40% between 2008 and 2012, which is an astounding figure. In short, for Vietnam to sustain its growth momentum and emulate China's success, it must abandon previous methods. Addressing issues in higher education, infrastructure, and notably enhancing the competitiveness of its public sector becomes imperative. That's it for today. And now we invite you to share your thoughts in the comments. Do subscribe to the channel if you like our content. We will catch you in the next one. Bye.